99% of investors lose money in the stock market. A shocking statistic, isn't it? The financial market, with its promises of wealth, swallows up the majority and only lets a small group prosper. What do those 1% know that you don't? In the face of so much volatility, patience and knowledge become the most powerful weapons. Fear and greed, these two monsters, destroy wallets and dreams. Emotional decisions lead to ruin. Those who control these emotions navigate the storms of the market and emerge victorious. How do these chosen few manage to profit consistently? Strategy, discipline, and a deep understanding of the market are the secrets. They diversify, avoid pitfalls, and have access to insider information. Want to find out more? Let's explore the mysteries of the stock market and reveal why so many fail while few triumph. 1. The myth of quick riches. 1. Attraction to easy profit is a fatal deception. Many beginner investors are seduced by the idea that the stock market is a fast track to wealth. Success stories of investors who have made millions in a short time feed this illusion. However, the reality is quite different. Most people eventually find that the journey to financial success is full of challenges and requires much more than luck. 2. Patience and knowledge are the real key. The stock market is not a game of chance, but rather an environment that rewards those who study, analyze, and make informed decisions. Successful investors spend years learning and refining their strategies. Without this commitment to continuing education, many end up making rash decisions that result in significant financial losses. 3. The reality is harsh, but not impossible. To stand out in the market, you need to have a long-term mindset. This means being prepared to face ups and downs and resisting the temptation to seek quick gains. True wealth in the stock market comes with time, consistency, and the application of sound strategies. Those who don't understand this are usually part of the 99% who lose money. 2. Lack of financial education. 1. Financial ignorance is costly. Most people who enter the stock market do not have the financial education necessary to make informed decisions. Without understanding basic concepts such as diversification, risk analysis, and portfolio management, investors are vulnerable to costly mistakes. This lack of knowledge is one of the main reasons why 99% end up losing money. 2. Knowledge is power in the stock market. Investing without a solid foundation of financial education is like sailing on the open sea without a map. Successful investors take the time to learn about the market, read books, attend courses, and keep up with trends. This knowledge allows them to identify opportunities, avoid common pitfalls, and make decisions that maximize their returns. 3. The pursuit of continuing education is essential. To get out of the 99% group, it is essential to invest in your own financial education. This includes understanding the basics of economics, learning how to read financial statements, and developing analytical skills. The more informed you are, the greater your ability to make sound and profitable decisions in the stock market. 3. Emotional decisions. 1. Emotions are the enemy of rational investments. Fear and greed are two of the most powerful forces influencing investors' decisions. In times of panic, many sell their stocks at low prices, while in periods of euphoria, they buy overvalued stocks. These emotional decisions often lead to significant financial losses. 2. Emotional control is crucial for success. Successful investors know that staying calm amid market volatility is essential. They develop strategies to manage their emotions and make decisions based on analysis and data rather than impulses. Having a clear investment plan and sticking to it can help mitigate the effects of emotional fluctuations. 3. Discipline and strategy trump impulsivity. To avoid the pitfalls of emotional decisions, it's important to set clear goals and follow a disciplined approach. This includes setting loss and gain limits, diversifying one's portfolio, and regularly reviewing one's strategies. With discipline, it is possible to minimize risks and increase the chances of success in the stock market. 4. Diversification is key. 1. Don't put all your eggs in one basket. One of the most basic rules of investing is diversification. Concentrating all capital in a single asset or sector significantly increases risk. When that particular investment doesn't perform as expected, the losses can be devastating. Diversifying helps protect against these unexpected drops. 2. Spreading out the investments reduces the risk. Diversification allows investors to spread their risks across different assets, sectors, and geographies. This means that even if one investment performs poorly, the others can make up for the losses. This strategy not only reduces risk, but also increases the potential for consistent returns over time. 3. Successful diversification strategies. Savvy investors diversify their portfolios with a mix of stocks, bonds, real estate, and other assets. They also pay attention to global trends and allocate resources in different international markets. This comprehensive approach allows them to adapt to economic changes and maximize their profits. 5. Cost of fees and commissions. 1. Hidden fees can eat into your profits. Often, investors don't realize the impact of fees and commissions on their returns. Brokers and fund managers charge fees that, over time, can significantly reduce profits. It is essential to be aware of these costs and seek more cost-effective alternatives. 2. Understanding and minimizing costs is crucial. To maximize returns, investors should understand all of the fees associated with their transactions and look for ways to minimize them. This can include choosing brokers with lower fees, negotiating fees with fund managers, or investing in passive funds with lower administration costs. 3. Transparency in fees increases profitability. Investing the time to understand the cost structure and opting for more efficient investments can make a big difference in the long-term results. By reducing fees, more money is available to be reinvested, increasing the portfolio's growth potential. 6. Planning and strategy. 1. Investing without a plan is a common mistake. Many investors enter the stock market without a clear goal or a set strategy. This impulsive approach can lead to poor decisions and financial losses. Having a well-defined investment plan is essential for achieving success. 2. Set clear and measurable goals. An effective investment plan starts with setting clear and achievable goals. Whether it's for retirement, buying a home, or educating children, having specific goals helps guide investment decisions and stay focused. 3. Adapt your strategy over time. The stock market is dynamic, and investment strategies need to evolve with economic and personal changes. Regularly reviewing and adjusting your investment plan ensures that it remains relevant and effective, maximizing your chances of long-term success. 7. The game of the pros. 1. Professionals have a significant advantage. Investors who consistently profit in the stock market often have access to resources, information, and tools that the average investor does not. They utilize advanced technical analysis, detailed financial data, and networking to make informed decisions. 2. The competition is fierce. Institutional investors and professional traders operate on a different level, often utilizing high-frequency algorithms and strategies. Competing with these pros requires more than just luck. It requires in-depth knowledge and access to advanced technologies. 3. How to level the playing field. While it is difficult to compete directly with professionals, individual investors can improve their chances of success by continually educating themselves, utilizing available analysis tools, and taking a disciplined approach. Seeking advice from financial advisors and participating in investor communities can also provide valuable insights and improve decision-making. Looking at the statistic of 99% failures in the stock market is scary. However, now you know the secrets that separate the losers from the winners. What will you do with this knowledge? Will you remain part of the 99%, or will you join the select group of the prospering 1%? Every decision counts. Every move can be the difference between winning and losing. Emotions are not investors' friend. Strategy and discipline are. But there is always more to learn, always new strategies to explore. Are you ready to transform your approaches and defy the odds? Remember, the stock market is not forgiving of repeated mistakes. Now that you know the most common mistakes and how to avoid them, it's time to take action. Ask yourself, what will be the next step in your investment journey? Stay tuned for more valuable insights and keep evolving as an investor.